A clear defined long-term range, comprises recent gaps and gap fills, and aligns with large swing points in the past just under record highs. The long-term downtrend line from a past peak exerts decisive resistance to end the promising uptrend. Taken in the broader context, the small uptrend was under additional pressure, in the form of the clear downtrend line intersecting with the final downswing in a triple top that reuses the 2130 to 2310 range. There is also a failed ascending triangle due to the upward slope of the upswings in March and April. Although the gap down strongly continues long-term bearish sentiment, it is normal to see the gap down range stall around 19 due to the clear referencing of the February upswing that contained short to medium-term bullish sentiment. More recently, the chart has shifted back to an increasingly bearish stance with the last 3 candles. The minor neutral to bullish range from June to July mainly had low volume compared to the major drops in late May and early August that form classic 3 methods falling price action on a large scale. As selling volume begins to drastically drop off into mid-August, the wider 15 to 17 range emerges as a range of interest as it can be the start of a large bullish reversal, having the potential to return to the 20s. As a shallow incline develops from September, the early stages of an uptrend will look to the wider gap down range for upcoming resistance. First, the early June upswing area around 18. Followed by the main bearish volume concentration closer to 19 where the gap down opened and continued lower in early August. This is indeed a triple bottom from August to early September, but it has not completed in the normal way with a more vertical break of the upper boundary around 1650. Instead, there are consecutive downswings and upswings that don't invalidate the pattern because they don't breach the lower boundary in the 15 range. Instead, this is a less common variant of a triple bottom, where an uptrend has a more gradual buildup of bullish volume and price action as the chart rises over the upper boundary, while selling volume is still present but at lower and continually declining levels. As expected, there is greater resistance approaching the upper boundary of the wider gap down range. 1925, around the opening price of the gap down candle, theoretically has the highest concentration of interest from bullish and bearish perspectives, since that is where bearish sentiment continued to hold down price immediately after the gap down. The uptrend made considerable progress until the last few days that saw clear bearish price action in the candles, and a noticeable increase in selling volume. Naturally, there is greater support the closer the chart drops to the triple bottom range, and the wider bullish reversal range that encompasses the subsequent incline from September to October, around the broader 15 to 17 range. A triple bottom with ideal features has formed to provide more favorable conditions for the reversal of the minor November downswing. Attention is now directed at the increasingly likely scenario the triple bottom leads to the establishment of trading over 1925. While January 20th was heavily bearish, it was only in the very short-term intraday context. The next week of trading saw a typical phase of lower activity at or just under the triple bottom's upper boundary, prior to the decisive break higher. Although both these triple bottoms didn't complete immediately after price traded or even closed over their upper boundaries, they both displayed noticeable inclines during or after their development. This helped create the broader context of favorable conditions to start and continue the long-term recovery. without necessarily having exceedingly high bullish volume all the time. It also helped selling volume had generally subsided since early August. A few red spikes are normal. There were never periods of sustained bearish volume well above normal levels. Price action was also neatly contained within the triple bottoms to demonstrate stability that transfers over to the solid uptrend line. Later gap ups make great progress nearing the gap down fill because they strongly close higher with sustained bullish volume. If bullish sentiment wasn't overwhelmingly strong, this return back to the solid gap down fill resistance would easily be repelled. As usual, the chart eventually slows down and displays neutral to bearish price action after the uptrend line originating from a solid bullish pattern is breached. Unsurprisingly, when there is the return of another strong long-term downtrend, there is strong support around the solid lower 20s range, now reversing roles to increase the chances of a bullish reversal. This was a near-perfect double bottom to begin 2016, as major selling volume decreased at the beginning of the pattern. Even before that, the downtrend was gradually decelerating, with some sporadic but mainly unsustained bullish spikes. The second upswing has much lower selling volume, and it is a clear morning star formation followed by progressively increasing bullish price action and volume to swiftly complete the double bottom without any delay. Prior to the gap down, there is a bearish reversal range that can be classified as a delayed double top. The minor upswing and downswing in late March almost form a triple top. Though regardless of the exact bearish pattern, the key area to watch was the temporary lower support around the 29 area. April to May sees a very strong bearish continuation, as the major lower 20s range steadily goes from neutral to heavily bearish, with only a brief pause in bearish volume. Due to the solid background of the lower 20s range, it manages to hold for a few years, but the long-term outlook of bullish growth gradually erodes. That is enough to decisively breach this significant range in 2019. New lows are firmly established as there are a series of sharp downswings just under 20 in late 2019 to consolidate the downtrend further. It's a familiar sight where a major downtrend begins to slow down in the short to medium term. In order for a significant uptrend to take place, there will need to be a sustained influx of bullish volume, while selling volume decreases to at least normal levels. Good progress for an uptrend rising in the short term, as the uptrend starting in April steepens with adequate bullish volume above normal levels along with consecutive closes higher. As usual, it is slightly more difficult to identify a reverse head and shoulders, especially since the right side had two minor upswings. However, it did have a clear declined neckline that was decisively breached in late May. Also, it is normal the uptrend begins to face major opposition upon returning back to the lower 20s area, since it is a range of long-term contention. It is also a clear area to reference for bearish price action in the recent past.